Statements of comprehensive income and financial position are key financial documents that show an organization's performance and stability, and they can be used to measure profitability through profit margins, liquidity through current ratios, and efficiency through asset turnover. A statement of comprehensive income is a financial document that records an organization's income and expenditure over a specific period to show overall profit or loss. The purpose of a statement of comprehensive income is to provide stakeholders with a clear picture of how much profit or loss the organization has made during an accounting period. The uses for a statement of comprehensive income include assessing business performance, comparing results over time, guiding management decisions, and informing investors and creditors. The elements of a statement of comprehensive income are revenue, cost of sales, gross profit, expenses, operating profit, interest, tax, and net profit. Revenue is the total income earned by a business from its normal operations before any costs are deducted. Cost of sales represents the direct costs of producing goods or services sold by the business. Gross profit is the difference between revenue and cost of sales, showing how efficiently a business produces or buys its goods. Expenses are the indirect costs such as administration, marketing, and utilities that are deducted from gross profit to calculate operating profit. Operating profit is the profit made from normal business activities before interest and tax are deducted. Interest is the cost of borrowing money or the income earned from investments. Net profit before tax is the profit remaining after all expenses and interest have been deducted but before tax is applied. Tax is the amount payable to the government based on the organization's taxable profit. Net profit after tax is the final profit remaining after all costs, interest, and taxes have been deducted. Depreciation is the reduction in value of a non-current asset over time due to wear and tear or obsolescence, and the difference between straight-line and reducing balance depreciation is that straight-line charges an equal amount each year while reducing balance charges a higher amount in the early years. A statement of comprehensive income is adjusted for depreciation by including a depreciation expense to reflect the decrease in asset value, which reduces profit for the period. Prepayments are expenses paid in advance, while accruals are expenses incurred but not yet paid. A statement of comprehensive income is adjusted for prepayments and accruals by reducing expenses for prepayments and increasing expenses for accruals to ensure that only costs relating to the accounting period are recorded. A statement of financial position is a financial document that shows a business's assets, liabilities, and equity at a specific point in time. The purpose of a statement of financial position is to provide a snapshot of a business's financial health and stability by showing what it owns and owes. The uses of a statement of financial position include assessing liquidity, measuring solvency, evaluating financial structure, and supporting decision-making by managers and investors. Non-current assets are long-term resources owned by the business such as property, equipment, or patents that provide value over several years. Tangible non-current assets are physical items like buildings and machinery that are used in operations to generate income. Intangible non-current assets are non-physical resources such as goodwill, trademarks, or software that add long-term value to the business. Cost represents the original purchase price of a non-current asset before any depreciation or amortization. Depreciation and amortization are methods used to spread the cost of tangible and intangible assets over their useful lives to reflect their gradual loss in value. Net book value is the value of an asset after accumulated depreciation or amortization has been deducted from its cost. Current assets are short-term resources expected to be converted into cash within 1 year. Inventories are goods held for resale or production that represent a key part of current assets. Trade receivables are amounts owed to the business by customers for goods or services provided on credit. Prepayments are amounts paid in advance for goods or services that will be received in the future. Bank refers to the cash held in a business's bank account available for immediate use. Cash represents the physical money held by the business. Current liabilities are short-term debts that must be paid within 1 year. A bank overdraft is a facility that allows the business to withdraw more money than it has in its bank account. Accruals are expenses that have been incurred during the period but have not yet been paid. Trade payables are amounts owed by the business to suppliers for goods or services received on credit. Net current assets or liabilities represent the difference between current assets and current liabilities, showing short-term financial health. Non-current liabilities are long-term debts that are due after more than 1 year. A bank loan is borrowed money from a financial institution that is repayable over an agreed period. A mortgage is a long-term loan secured against property or land owned by the business. Net assets are the total assets minus total liabilities, representing the business's overall worth. Total equity represents the owner's interest in the business after all liabilities have been deducted from assets. Opening capital is the amount of money or assets invested in the business at the start of the period. Transfer of profit or loss represents the movement of net income or loss from the statement of comprehensive income to the capital account. Drawings are withdrawals made by the owner for personal use, reducing the business's capital. Closing capital is the final balance of the owner's equity after adding profits and subtracting drawings. Adjustments for straight-line depreciation are made by applying a fixed percentage of the asset's cost each year to calculate the annual depreciation expense. Adjustments for reducing balance depreciation are made by applying the depreciation rate to the asset's net book value after previous depreciation has been deducted. Adjustments for prepayments are made by reducing expenses to remove amounts paid in advance that do not relate to the current period. Adjustments for accruals are made by increasing expenses to include costs incurred during the period that have not yet been paid. Profitability is the ability of a business to generate income that exceeds its costs and expenses over a specific period. Profitability is measured by comparing profit figures with sales, assets, or capital to assess how effectively a business uses its resources to earn returns. The different types of profitability are gross profit margin, markup, profit margin, and return on capital employed, each providing insight into different aspects of financial performance. Gross profit margin measures how efficiently a business produces or buys goods compared to its revenue and is calculated as gross profit divided by revenue times 100. Markup measures the percentage added to the cost of goods to determine their selling price and is calculated as gross profit divided by cost of sales times 100. Profit margin measures how much profit a business makes from its total revenue and is calculated as profit divided by revenue times 100. Return on capital employed measures how effectively a business uses its total capital to generate profit and is calculated as profit divided by capital employed times 100, where profit for the year equals revenue minus cost of sales and expenses, and capital employed equals total assets minus current liabilities or non-current liabilities plus total equity. Liquidity is the ability of a business to meet its short-term debts as they fall due using its current assets. The different liquidity ratios are the current ratio and the liquid capital ratio, which both assess the business's capacity to pay its immediate obligations. Current ratio measures the relationship between current assets and current liabilities and is calculated as current assets divided by current liabilities. Liquid capital ratio measures a business's ability to pay short-term debts without relying on the sale of inventory and is calculated as current assets, inventory, divided by current liabilities. Efficiency is the ability of a business to use its resources effectively to generate income and control costs. The different ways of measuring efficiency are trade receivable days, trade payable days, and inventory turnover, which each assess how well a business manages its working capital. Trade receivable days measure the average number of days it takes for a business to collect payments from customers and are calculated as trade receivables divided by credit sales times 365. Trade payable days measure the average number of days a business takes to pay its suppliers and are calculated as trade payables divided by credit purchases times 365. Inventory turnover measures how quickly a business sells and replaces its stock within a period and is calculated as average inventory divided by cost of sales times 365. The limitations of using ratios when assessing business performance are that they can be affected by external factors, rely on historical data, may not be comparable across businesses, and can be distorted by accounting policies. One limitation is that ratios can be affected by external factors such as changes in the economy or market conditions that the business cannot control. Another limitation is that ratios rely on historical data, which may not accurately reflect current or future performance. A further limitation is that ratios may not be comparable across businesses due to differences in size, industry, or accounting methods. An additional limitation is that ratios can be distorted by accounting policies or estimates, reducing the reliability of comparisons and conclusions. Thank you for watching this video on Statements of Comprehensive Income and Financial Position. I'll see you in the next one.